Good afternoon. I'm Chris Denicolo, and thanks again for joining us for another Lunch and Learn webinar. Today we're going to be talking about charitable remainder trusts, how to add a new tool to your belt. Now in this talk today, I want to go over some of the nuts and bolts and basics regarding charitable remainder trusts, and then we'll get into some more bells and whistles and some different uses for these types of trusts. At the very fundamental level, a charitable remainder trust is a split interest trust in that part of the trust is held for the benefit of charity, the other part is held for the benefit of one or more non-charitable beneficiaries. Now, overly simplistic, a charitable remainder trust is such that the charity is entitled to the remainder of the trust. So a basic form of charitable remainder trust will provide that for a term of years that does not exceed 20 years, or for the life of one or more beneficiaries, a non-charitable beneficiary will be entitled to a certain number of payments, and we'll talk about the variations on the types of payments, while the charity will be entitled to receive the assets remaining in the trust after the term. Contrast this with something known as a charitable lead annuity trust or charitable lead unit trust, which has the different interests flipped. Whereas in a lead trust, the charity is entitled to receive distributions from the trust for a certain term of years, and thereafter assets are held for non-charitable beneficiaries. So today we're talking only about charitable remainder trusts. And as I said, a charitable remainder trust can provide for a term for a non-charitable beneficiary, really based upon either the life of one or more beneficiaries or a term not to exceed 20 years. Now, the donor can decide to select the charity up front. They can retain the right to change the charity that will receive it after the term. And the idea here is that that will not jeopardize the income tax deduction. Because when assets are transferred to a charitable remainder trust, there's an actuarial calculation. And that calculation is based upon the IRS promulgated interest rate and the terms of the trust, so that the present value of the remainder interest, based upon the assets that go into the trust, the value of the assets, hypothetically determined as of the contribution date, will determine the value of the remainder interest. And that will allow us to determine the income tax deduction and any estate or gift tax deduction to the trust. And I'll get into some mechanics of how that's determined. Now, the charitable remainder trust is tax exempt. It's not a Section 501c3 entity, but the trust itself does not pay tax. However, when distributions are made to the non-charitable beneficiaries, income tax is carried out on a worst out, first out basis, meaning that ordinary income goes out first, followed by capital gains, followed by accumulated income, followed by return of corpus. Likewise, charitable remainder trusts are subject to self-dealing rules that normally are applicable to private foundations, unless no charitable deduction is taken at the time of the contribution or during the life of the trust. And you're probably thinking, well, why would you ever create a charitable remainder trust and not take a charitable deduction? Well, there are reasons, and we'll talk about those as we start getting into different layers of complexity. So moving forward through slide 3, you'll see here I've taken an excerpt of Internal Revenue Code section 4947, which governs these split interest trusts and also references charitable remainder trusts to provide you with a little statutory basis for these types of trusts. So in determining the amount of, or determining the type of charitable remainder trust, there's really two types. There's the charitable remainder annuity trust, which is a CRAT, or a charitable remainder unit trust, which is a CRUT. And the real difference is as follows. An annuity trust, a CRAT, specifies a fixed dollar amount for which defines the payments that go to the non-charitable beneficiaries. This fixed dollar amount must be at least 5% on an annual basis of the initial fair market value of the property, but can't be more than 50%. And again, as I said, the term of the non-charitable beneficiary's interest must be based upon either up to 20 years if it's a flat term, or the life of one or more non-charitable beneficiaries. There's another little wrinkle here. For a CRAT, you have to meet something known as the 5% probability test. And this test says that there must be at least a 5% chance that the trust assets will be exhausted before the end of the term. And if you don't meet this test, you can't get a charitable deduction. And really what this means is that the CRAT must be structured such so that the non-charitable beneficiaries aren't likely to receive, or don't have a 95 or greater % chance of receiving all of the assets, so that there'll be nothing left for the charity. A CRUT, a little bit different. A CRUT provides for fixed payments based upon a percentage of the net fair market value of the property under the trust as it's determined each year. So just to give you an example, a CRUT can provide for a 6% annual distribution right to a non-charitable beneficiary, and that 6% is based upon the prior year's value, meaning that every year you have to revalue the assets under the CRUT to make sure that you can comply with these distribution requirements. A neat thing about a CRUT is that you don't necessarily have to worry about the 5% probability test, because every year the payment amount is determined with reference to the prior year's value, which means that you're never going to have an issue with the 5% probability test, because there's always going to be a decline in the amount of the annuity of the unit trust payments, if the value of the assets of the trust go down. Now, I want to mention that the CRUT and CRAT can be established during the lifetime of the settlor or upon death. So you can have an inter vivos or a testamentary. So you can actually have a charitable remainder trust set up upon the death of the grantor, and we'll talk about how that can be useful with respect to planning for retirement plans. As I mentioned, the charitable deduction is based upon the actuarial value of the remainder interest that goes to charity. It doesn't matter what happens under the term of the trust. So if you put $1 million into a CRAT, for example, a CRUT, for example, and it turns out that the performance of the CRUT is such that you're not going to have any assets left after the non-charitable beneficiary's term, that doesn't matter. It's determined up front. And this 5% exhaustion test is determined up front. So if market circumstances are such that you don't have assets left for the charitable beneficiary after the term, that's not going to jeopardize your charitable deduction. And that applies for both a CRUT and a CRAT. The interest rate that you use to determine these actuarial calculations is the IRS Section 7520 rate, which comes out every month. Now, one thing you can do is use the rate for the month of funding of the trust, or one of the 2 prior months. And with a charitable remainder trust, if you have a lower interest rate, that's going to generate a lower charitable deduction. So higher interest rates are actually better here if you're trying to maximize the charitable deduction and the amount that can go to charity. Now, the term of the trust also depends upon, also factors into the amount of the charitable deduction. And this relates to a longer term, generally resulting in a smaller charitable deduction. And that makes sense, because the longer the term of the non-charitable beneficiary, the more payments they're going to receive and the larger their interest. So those are considerations, and we typically just use a computer program. Tiger Tables is one, Number Crunchers is another program, where you just punch in all the inputs and it spits out exactly what the charitable deduction amount would be, the amount that's actuarially expected to go to the non-charitable beneficiary versus the charitable beneficiary. Now, if the non-charitable beneficiary is not the settlor, then you can have a situation where gift tax might be owed on the non-charitable portion of the trust. And just to give you an example, if you put $1 million into a CRUT and you run the numbers and you find out, well, the non-charitable beneficiary's expectation is 70% of the million, so 700,000. And if that goes to, let's say, children of the grantor, then there's a $700,000 gift actuarially. And let's say that, and I'm just using round numbers here, the numbers of course are a little bit different based upon time value of money. Let's say that the charitable share is 32%. Well, then you have a charitable deduction equivalent to $320,000, but you still have that gift of the term interest, whether it's based upon a term of years or lifetime of a beneficiary. And here on slide 6, we have just a couple of distribution percentages that are actuarially determined based upon these calculations. And these numbers are something we ran back in February, I believe, when we were doing a lot of research into using charitable remainder trusts for IRAs and retirement plans. And we'll get to that here in a few minutes. So the numbers might not be current, but looking at this, you'll see that if you have someone who's 30 years old, you know, the maximum amount that a CRUT can pay out to meet this 10% test. And this 10% test is that the charitable beneficiary must have an actuarial expectancy of at least 10% of the value of the assets going in. And if you base it on someone's lifetime, if they're young enough, that 10% test could be flunked. And we found that if the non-charitable beneficiary was 28 years old roughly, then you would flunk that 10% test, in which case you would have to use this up to 20 year term of years. And these percentages show the amount that would have to be distributed each year from the CRUT in order to meet that 10%. And these amounts are maximum amounts, I should say. You know, you have to distribute at least 5% for a CRUT, but you know, based upon that 10% remainder and the actuarial calculations, these are the maximum amounts that can go out to the non-charitable beneficiary. And of course, the more individuals that you add as non-charitable beneficiaries, the lower that maximum becomes, because the life expectancies of more than one beneficiary are longer than just one beneficiary based upon actuarial tables. So something worth considering. So CRUTs are generally used in a lot of situations, and one of such situations is to avoid possible capital gains tax on the sale of an appreciated asset. And this would involve putting in an asset maybe worth $1 million here that's appreciated before it's liquidated or sold to have the capital gains occur under the trust. And as I mentioned, charitable remainder trusts are not subject to tax themselves. But when distributions come out, tax will be passed on to the non-charitable beneficiary. So in this spreadsheet here, you'll see that if you put this $1 million into the trust, and each year, you know, it makes payments based upon 10.8% of the balance. This is actually a unit trust, a CRUT. At the end of the 20-year term, what you have, the family receiving about 2.2 million. See in the bottom right corner there, and the charity is going to get about 566,000. Now the 2.24 million there is the cumulative of the distributions received by the family after the taxes on the distribution. So that's a cumulative amount. It doesn't necessarily factor in time value of money. It's more of a nominal basis. And then you'll see that the charitable entity receives about $566,000. Now, if no planning was done, you'll see on the next slide here, the family, you know, if this is, by the way, if the $1 million asset was sold and the tax was paid, the family would receive after 20 years about 1.458 million. So quite a bit less, and the family can really derive a nice benefit from using this type of structure if you have an asset that's going to sell and generate a lot of capital gains taxes or have a liquidity event. It's a very beneficial type of technique, and a lot of your clients might like it, even if they're not necessarily charitably inclined. And as I go through here, you know, these slides, I just want to mention on slide 10, we have a summary of what would happen. And by the way, on slide 9, just to give you some context, this is a spreadsheet showing what would have to happen each year. So if you didn't do the CRUT and you just gave the charity each year an amount, so that at the end of 20 years they received a nominal amount of 566,000, assuming an 8% growth rate, the family's going to get 1.3 million, which, as indicated on slide 10, is a lot less than what would happen under the CRUT. So really interesting plan here to use the CRUT to defer capital gains tax. And you'll see here at the end of slide 11, slide 11, excuse me, there's a pictorial chart showing the various differences of using the CRUT versus not using the CRUT. So with anything here in the tax law world, we can start adding layers of complexity. And now I'm going to add a few more letters to a CRUT in another word, and we'll call it a Flip-NIMCRUT or just a NIMCRUT. A NIMCRUT is a net income with makeup charitable unit trust. What's unique about this trust is that if you have a normal CRUT, which says every year pay out 6% a year to the non-charitable beneficiary, the NIMCRUT can be drafted to say you pay out the lesser of the 6% amount, the unit trust amount that is, or a fiduciary accounting income that's available for distribution. And if there's no fiduciary accounting income or very little fiduciary accounting income, the 6% amount doesn't have to be distributed, which allows the assets to stay under the CRUT and essentially cook on a tax-deferred basis. And this idea of a Flip-NIMCRUT allows for a future event to occur to turn this NIMCRUT into a normal CRUT, where distributions have to start being made and made up in the future to the extent that there is available income. So with this type of charitable remainder unit trust, what you could do is you can set it up so that you have a disregarded LLC underneath the trust to own this appreciated asset. And the LLC serves as a blocker entity in that, there's no fiduciary accounting income under the trust unless a distribution actually comes out of the blocker entity, even though it's disregarded for federal income tax purposes. And this is based upon the Principal and Income Act that applies here in Florida and in a lot of other states. So this blocker LLC essentially allows somebody to flip the switch in the future to start triggering fiduciary accounting income to make up payments that it's missed, which of course allows for the tax-deferred buildup of assets underneath the LLC. Now, to have this Flip-NIMCRUT, you have to have a triggering event apply under the trust. So the trust instrument must say, upon the occurrence of this event, this triggering event, whatever it is, which could be a set date or an event. The IRS has a list of 7 permissible events in final regulations. We'll talk about those in a second. And then upon occurrence of that triggering event, you would have the makeup provisions apply so that the non-charitable beneficiary can receive distributions associated with the unit trust payments that were missed. One such triggering event is the sale of an unmarketable security. So you'll see in a minute, I have a chart that'll show this other LLC, not the LLC that's the blocker that owns the underlying appreciated asset, but this other LLC that has nominal assets. And if the manager of that LLC and the members of that LLC sell the LLC, that event could trigger the NIMCRUT as the flip triggering event to cause the income to pass through to the non-charitable beneficiaries. As promised, here are the list of the triggering events under the regulation. So as I mentioned, the sale of a non-marketable security, which can be a corporation, an LLC, that maybe has a promissory note from an unrelated party, or even marketable securities itself. And then independently significant events such as the divorce or marriage of a donor, whether the income recipient has a child, the death of the income recipient's relative, the sale of the donor's principal residence, or upon the income recipient reaching a certain age. This doesn't appear to be exclusive, but it's probably best to stick within the bounds of what's prescribed by the IRS. So just to reiterate what I've just mentioned, you have these 2 Flip-NIMCRUTs called Alpha and Beta, and this blocker LLC that's taxed as a partnership with a trust company as the manager, and then this blocker LLC owning another asset. In this case, it's the generically named ABC LLC, which will be sold for what's expected to be a large gain. The blocker entity blocks the income from reaching the NIMCRUT, therefore blocking the requirement that the unit trust payments be made out to the applicable beneficiary. So Alpha LLC on the left and Beta LLC on the right are your non-marketable securities, the sale of which will cause this NIMCRUT, or each applicable NIMCRUT, to flip to a normal CRUT and having to make up the previous payments. And one other note here before I move on, at the very beginning, we have, at the very top, I should say, we have a dynasty trust creating this. And one benefit to doing so is that if you have assets that are out of the client's estate and you're not necessarily looking for the charitable deduction, you're just more or less using the CRUT to defer income tax for sales of appreciated assets that might occur. You can structure this so that there is no charitable deduction. You don't have the self-dealing rules apply, so you can engage in transactions with the trusts without worrying about running afoul of the self-dealing and prohibited transaction rules that apply ordinarily to CRUTs if a charitable deduction occurs. So, as I mentioned, this is a very common scenario where we would use this type of situation. If you have ABC company, for example, with $1 million and you expect a large gain, you can structure it in order to avoid the possibility of recognizing the income tax. So if you look here on the bottom of slide 18, you'll see with this $1 million contribution, based upon this appreciated asset, if it's sold, at the end of the 20-year term, the charity is going to receive about $242,000. The family is going to receive quite a bit, including a large amount in year 20, because in year 20, we have this makeup distribution that goes out to the client. And just so you see beforehand, the nominal distributions in years 1 through 19 are there in order to, maybe dividends or some other nominal income held by the trust. Now, this shows what happens if the charitable deduction is taken. And of course, on the front end, the family gets a charitable deduction based upon around $52,000 due to the actuarial factors. If we eschew the charitable deduction, you have the same results at the end. The family gets the same amount, about $2.785 million. Charity gets approximately $242,000, but there's no charitable deduction to the family. So the charitable deduction might not be that significant. And as I mentioned, the primary purpose of this charitable remainder trust is indeed to exclude or defer federal income tax that might occur with respect to the sale of the appreciated asset, as opposed to obtaining this charitable deduction. If we didn't do any planning for this family, you would notice that there's quite a bit of taxes paid here, and the family would receive quite a bit less than would occur. And slide 21 here shows the summary of those distributions. I'm sorry, slide 22 shows the summary as to what happens under the various techniques that apply, various variations of the techniques that apply. And in here, for those of us who like to see it in graph format, you can see that the family is going to receive quite a bit more if you do the NIMCRUT, this Flip-NIMCRUT, as opposed to no planning. Of course, this assumes growth going into the future at rates of 8%, I believe. So, it's not necessarily a guarantee, but in most situations, you're going to have a better result for the family if you use the NIMCRUT as opposed to no planning. And then in comparing the regular CRUT to the NIMCRUT, the amount received by the charity is going to be a little bit higher, and the amount received by the family is going to be a little bit higher if you have the NIMCRUT as opposed to the CRUT. And the reason for that is you have this period of time during which you can have the assets under the trust bake on a tax-deferred basis, as opposed to the CRUT, which requires the annual payment every year, come hell or high water, but without regard to this net income makeup right. Now, as I mentioned, self-dealing, we talk about this idea that if you take the charitable deduction, you can't engage in transactions because the self-dealing rules apply to NIMCRUTs if the charitable deduction is taken. I would suggest, considering what's really the objective in your discussions with the client about how to use this type of trust. If they truly want to make sure that they're getting an income tax charitable deduction, then I think you got a draft for that, and you may want to look into a normal type CRUT. You might want to look into as to when to flip the NIMCRUT, or as to how to draft the trust in order to assure that you get the charitable deduction. Whereas if the primary purpose is the deferral of income tax associated with the sale of an appreciated asset, then you may want to try to not get the charitable deduction to leave open the possibility of being able to engage in future transactions with the trusts. So now I'm going to jump ahead to slide number 29. And really another use of charitable remainder trusts that has experienced an advent in the last 6 or so months is in the realm of retirement and IRA planning. And this is as a result of the Secure Act. Those of us who've followed the Secure Act know that it's revolutionized IRA planning so that no longer are most beneficiaries of IRAs and retirement plans entitled to stretch out distributions, required minimum distributions, that is, over the beneficiary's life expectancy. Now, most of the time, it's got to come out within 10 years unless the IRA or retirement plan is made payable to one of 5 different types of beneficiaries known as eligible designated beneficiaries. So we look at this pyramid here on slide 29. This eligible designated beneficiary pyramid really just shows us the different tiers and favorability of various beneficiary situations. The optimal tier is the surviving spouse, who is one of those 5 beneficiaries, those eligible designated beneficiaries. And the surviving spouse is the prime tier because the spouse can roll over the IRA into his or her own IRA. They can receive distributions for life expectancy if they'd like. They can roll over part of the IRA, keep the rest as a beneficiary, and they can pull it out over life expectancy, similar to what applied under previous law. Tier 2 is a trust for a, excuse me, back to Tier 1, I jumped ahead here. In Tier 1, you have these other types of eligible designated beneficiaries: chronically ill or disabled beneficiaries, minor children, or a beneficiary who is under the age, who is no more than 10 years younger than the deceased participant. All of such beneficiaries can get the stretch over their life expectancy as beneficiaries. Now, minors are a little bit different because minors, when they hit the age of majority, they have to start pulling out distributions, and the 10-year rule applies at that point, which means that when a minor reaches the age of majority, which, by the way, is determined under state law and can be a variety of anything from 18 to 26 in some states, would require that all distributions come out of the IRA under the 10-year rule, which itself says that everything must come out by December 31 of the year following the year of the death of the participant. So if I die here in 2020, well, my non-spousal beneficiaries, and I leave an IRA to, let's say, my sister who's in her 30s, she has to pull out, she's entitled to receive distributions because she's no more than 10 years younger. But let's just say, for argument's sake, I leave it to a non-minor cousin who's more than 10 years younger than me. He would have to pull out benefits from the IRA by December 31 of 2030. So that is not as favorable. And if there is no designated beneficiary, meaning that if I leave it to a normal trust that doesn't qualify as a see-through trust, or if I leave it to an estate or to a corporation, then the benefits must come out of the IRA within 5 years. So how does this all matter for charitable remainder trusts? Well, one way to do it is to structure it so that the charitable remainder trust can receive benefits here. And the remainder trust, of course, is subject to the 5-year rule, meaning that everything must come out of the IRA over the course of 5 years. However, charitable remainder trusts are not subject to income tax. Therefore, when the assets come out of the IRA and go to this charitable remainder trust, they can be held, and the charitable remainder trust can pay to one or more non-individual beneficiaries, or non-charitable beneficiaries, pardon me, over a term of years or over the beneficiary's life expectancy, so long as the trust qualifies for that 10% remainder interest to charity. And this is kind of replicating the stretch that used to occur under prior law. This is a really neat tool that we've used since the Secure Act has come out. There's been a lot of literature on this. In fact, there's so many slides here regarding this technique. I'm not going to get to all of them in the few minutes that I have left. I do want to mention that ways to get it to the charitable remainder trust, can occur by directly leaving it to the trust or to a child who can disclaim it within 9 months of death to cause the assets to go into the charitable remainder trust. Likewise, benefits can be left to an accumulation trust, which is a trust that can receive IRA benefits and qualify for that 10-year rule. The trustee of the accumulation trust could disclaim the benefits from the IRA so that they go into a charitable remainder unit trust, and you get this stretch CRUT that I've outlined. I'm going to jump ahead to really show you mathematically how this could work. So if you have a taxpayer who dies with a $1 million IRA, we assume a 7% rate of return, we assume a 6% after-tax rate of return, and an IRS applicable federal rate of 2%. Under the 10-year rule, this $1 million IRA after 10 years, after tax comes out, the beneficiary is going to receive approximately $1,239,000. The ending balance at the 20th year and 25th year, if the beneficiary reinvests the after-tax dollars, on the right side are highlighted about $2.2 million after 20 years and about $2.9, almost $3 million after 25 years. If we use this charitable remainder trust, after 20 years, the charitable remainder trust is going to have about $450,000 or so left in it to go to charity, and the beneficiary is going to have received about $1.96 million, roughly. If the beneficiary reinvests the additional amounts thereafter, it's about $2.6 million after 25 years. So looking at these in comparison to one another, the 10-year rule is going to get more money in the hands of the beneficiary. That's unequivocal, and they're just going to pay the tax. However, using this charitable remainder trust could cause assets to go to charity, could generate some element of a charitable deduction, and can leave less money going to the government. So if the client is charitably inclined, they can use this technique to cause assets to pass to charity and to pass assets to family, on a tax-deferred basis. It may not be the same amount going to the non-charitable beneficiary, but overall, between the charity and the beneficiary, you're going to have more assets being available for the beneficiaries as opposed to going to the government. And certainly a lot of clients like that. The next slide, just the advantages and disadvantages that I've mentioned as to the different types of trusts here, whether we use a charitable remainder trust or a unit trust to receive the IRA benefits. And then one other note to point out with respect to a charitable remainder trust in the context of IRA assets: if the beneficiary is under the age of 28, they're not going to qualify for a lifetime charitable remainder trust, so you can use a 20-year term. However, you might be able to delay funding of the charitable remainder trust under the IRA so that it's not funded until the 5th year. So the 5-year rule applies. In the 5th year, monies go from a trust to a charitable remainder trust, in which case you have it then set up over the life expectancy of a beneficiary, in which case you might be able to qualify given the beneficiary's age, and allows it to work in light of the actuarial calculations. So it's a really neat tool for you to use. Charitable remainder trusts are not necessarily all about the charitable deduction. They do have utility as far as tax deferral goes in avoiding income taxes. It's certainly worthwhile for you to discuss this with clients, even if they're not charitably inclined. If the client likes saving taxes, and most of our clients do, then by all means, this can be a very much appropriate strategy. And for those of you who have joined our webinars in the past, you'll notice a lot of times we give more information, maybe some slides on different topics that don't necessarily pertain directly to the subject. So for the rest of the slides here, I'm not going to go over them, but I've included some of our materials on private foundations so you can see some of the restrictions and some of the elements that apply to private foundations, as a private foundation could indeed be the charitable beneficiary at the end of the charitable remainder trust. And of course, charitable remainder trusts in a lot of situations are subject to the same self-dealing and prohibited transaction rules that apply to private foundations. So thank you very much for joining us today. I appreciate you coming out to see this. If you have any questions, please feel free to email me. And we look forward to seeing you again for one of our forthcoming programs. Have a wonderful day.